This is we're going to talk about the chapter 4 on the entrepreneurship based on the financial viability. Okay, using the book of Building Your Dreams, Canadian Guide of Starting Your Business. This is 12 editions by McGraw-Hill, Good, Courteau, Yap, and Ford. Okay, let's start the class. Okay, this is the learning objective. The first, there's 4 of them, which is understanding concepts of financial forecasting is number 1. Number 2 is estimating the startup cost. Number 4 is the pro forma financial statement. Number 3, the pro forma financial statement. Excuse me. Number 4 is determine how to measure the financial viability of the business. Okay, let's look at the importance of financial forecasting. You're gonna develop a pro forma financial statement using income, cash flow, and balance sheet. Who are the people that you will use? Of course, the founders, the managers, shareholders, the investors, lenders, suppliers, as well as government. Okay, so let's look at the next one. Estimate your startup cost. It's a one-time startup cost. What are the capital expenditures? Example, I'm setting up a samosa shop. I just mentioned to you the furniture and equipment that I need to do. Let's say $500,000, the startup cost, inventory and supply. The soft cost will be the utility budgets. Basically to set up your electricity connections, set up your gas connections, set up all your utilities connections, pre-opening advertising, other prepaid expense. Okay, and then initial operating costs, let's say payment for ongoing expenses such as rent, sufficient to cover at least 2 to 3 months operation, and cash reserves should be available. Next one, professional income statement. Estimating the initial profit or loss expected by the business, measuring the company's sales and expenses during a specific period of time. So total revenue minus total cost, either profit or loss. So if revenue is higher than the cost, you're going to be profit. If this revenue less than total cost, it will be a loss. Okay, let's look at the retail and wholesale business. So the following points need to construct pro forma income statement. What are the predict sales volume or projected net sales? So it is a retail. Let's say samosa shop is going to start with the retail business, and then the projected cost of goods sold, you're gonna check how much you're gonna be your cost of goods sold, and fixed operating expense, the rental, let's say $1,000 a month, utilities, let's say $500 a month, insurance cost, let's say $250 a month. Then you're gonna forecast that. Variable cost will be advertising, wages, and delivery. So wages depends on the employee, how much employee you're gonna hire. Advertising, how you're gonna advertise this, either using internet, using Facebook, or you're gonna use a local newspaper. And then the expected net profit or loss. So the average, let's say, expected profit and net margin will be 30%. That's the standard in the industry of food industry. Excuse me. Sales forecasting, very difficult predictions to make. One method is design income approach, suggested by Shonzi and Steinhoff, which is financial projection that are based on the actual operating performance of firm, like the business that you are contemplating. Also provide return on personal capital investment and check the CIS profile. Okay, and then the CGS, which is cost of goods sold. Most retail and wholesale business depend their cost of goods sold by the value of the inventory at the beginning of the period being projected, adding value of any product purchased during the period, then subtracting the value of the inventory left by the end of the period. Cost of goods sold number 2, information to draw the income statement based on which is the inventory turnover, is the number of times a typical firm is sold each year, and then the gross margin is based on the difference between firm sales and cost of goods sold expressed as a percentage. And then pro forma analysis, which is net sales here, and then cost of goods sold here. Let's cost of goods sold here, okay, based on the beginning inventory plus purchases, good available for sale, and inventory you got here B. Okay, you got the gross margin here is C. Okay, that's the typical sample pro forma income statement. And then operating costs. What are the fixed and variables? You're gonna see here: labor, commissions, amortization, depreciation, repairs, all the way from utilities, rent, out to other expenses. Breakdown of operating costs as a percentage of sales for a typical store, sporting goods goods store. Okay. And then management service business, if it is a revenue model, it's a unit-based asset sales, usage fee, subscription or membership, transaction and brokerage fee, advertising base, and licensing or royalties. Okay, management service business, based on pricing tactic, cost-based pricing or value pricing. Okay, sales forecasting can either use top-down approach or first bottom-up approach. Okay, the price can be used. Let's say if you are making samosa, in the case, let's say your cost may be 25 or 50 cents per samosa, you're going to sell it at $1, which is 100% markup. Okay, value-based pricing, we're going to use, let's say for motorcycle chopper, it is based on the image and the creative art. So you're going to price it, let's say 30 to 40,000 or 50,000 per motorcycle chopper. Okay, and then factoring your sales can be external, such as seasonal changes, political activities, general economic conditions, holiday special events, fashion trend, population shifts, changes in retail market. That is your external factors. For example, for the motorcycle chopper, so you're gonna be seasonal changes. Why? Because motorcycle can only be used during summer and springtime. So in Canada, you can only use for 4 months to 3 months. The winter here is about 8 months. Okay. Internal factors, promotional effort, inventory management, distribution channel, relative pricing, as well as labor and personal issues. In terms of this distribution channel, you can do a direct channel from producer all the way directly to consumer. You can use a retail channel. You are the producer, you're going to use a retailer, go to as a consumer here at the end. Or you can use a wholesaler channel. You got a producer here, you got the wholesale distributor, you got a retailer here, a consumer, and then agent channel, you're gonna producer, agent, broker, wholesale, retailer, and consumer. So there's a lot of layout here. So everybody take a cut in terms of commission, in terms of profit. Okay. So this is what happens. What has Costco has done in the past. From wholesaler, they cut the wholesale, distributor, and retail. Just go straight to the consumer. That's why the pricing in Costco is cheaper. There's a very much high demand of that Costco department store. Every time you can come visit in Costco store, it's always full pack. And we know why? Because the price is cheaper. Introduction to the cash flow statement. Cash flow takes the expected cash flow in and out of business over some period of time. Cash flow is the lifeblood of business. Okay, here if you do not have a positive cash flow, you're in trouble because it's a lifeblood. Okay, non-cash accounting entry may show up in income statements such as depreciation, amortization, and assets that are ignored in forecasting or cash flow statement. Expenses that have been incurred but not paid. Income has been earned but not yet received, but not included in the statement either. Okay, so what are the things in terms of forecasting cash flow? There are 3 sections here. Operating activities that deal with the operation of the company. Investment activities will deal with investing of the company, such as put the excess money in deposits. Financing activities, let's say you want to buy equipment on a bank loan or using a stock or debt by issuing bond or promissory note. Okay, what are the cash flow formatting activities? As an example here, plus will be cash received from customer. Plus will be cash any other operating cash received, which we call total cash received from operations. But the negative one here, cash paid to supplier, cash paid to employees, interest paid minus tax paid, other payment expenses. So total coming from operation. We call it not cash provided by operation A minus B. Alright, let's say look at the cash flow from investment activity. Cash proceeds from the sale of asset minus cash disbursement of the purchased property or equipment called total net cost provided by the investment. Okay, look at the cash flow from financing activities. All the plus here is cash received from bank or loan, proceeds from issuing stock, plus from contribution of the owner. This is all the plus, cash flow received from financing. But the negative side will be repayment of principal, such as loan, dividend paid to shareholders, cash withdrawal by the owners, and other funds removed by the business. We call it total cash outflow, payment for financing. Developing your cash flow statement. You need to estimate your revenue. You must consider the following: your ratio, cash to credit or credit sales, your normal term of trade or credit for credit customer. And basically 30 days, if they pay earlier, you're going to give them, let's say, 1 or 2% discount. The paying habit of your customer, the sooner you receive cash, the better it is for your cash flow. That's basically what it is. The longer it is, the worse it becomes to your cash flow. Proceed from the sales of any auxiliary item other than the business. Okay, you must develop your cash flow. Estimating your expenditure, you must consider the following. Promptly will be required to pay your material and supplies. How will you pay your employees and wages and salary? You have to make sure you pay your employees on time. So if you keep your employees happy, then the business will be good, because this cost shows up in your customer. When you must pay rent, utility bills, and other expenses, you try to do it also on time. to keep the good credit score in your company. Interest and principal payment, you must also make each month for any outstanding loan. You plan to increase your inventory requirement or other additional assets. Okay, look at the developing your cash flow here. Forecasted cash flow in a month equal to cash balance carried over over the month in bracket x minus 1 plus x expected cash flow in the month minus estimate cash expenditure in the month. Okay, so this is a cumulative cash surplus or so that are evident in what advance their actual excuse me. Pro forma balance sheet. It is a snapshot of the health of the business at a point in time. So the formula will be asset equal to liability plus equity or net worth. Okay. Pro forma balance sheet will consist of current asset, fixed asset, current liabilities, long-term liabilities, as well as equity, net worth. Accounting practice, you have to have a record keeping. Because Excel is the most common being used. Cloud or online accounting solutions is available. You can use the most common will be a QuickBook or simply accounting or maybe iPack. Okay, but the most common one is QuickBook. 5 tips: plan for major expenses, track your expenses, record deposit correctly, and put money aside for taxes. Okay. Canadian tax system. Remember, Canada is one of those country that require you to file income tax every single year if you are a citizen or PR. Okay, GST and HST. Register for an HST account that you must open a business. Allow you to claim HST and HST that you have paid on your purchases. Must charge limit if income greater than 30,000. Okay. Measuring financial value. There's a break-even coin where total cost equal to total revenue. Indicate when your business begin to make a profit. If sales level is less than a break-even point, your business will suffer a loss. Break-even point will total fixed cost divided by contribution margin. This is called the break-even point. Where is contribution margin? Is selling price per unit minus variable cost. So what are the things you're going to look? This is the break-even point. There you go. Okay, in this case is 800. Sales and revenue, expenses, which is 800. This is your profit area here. This is your total cost. This is your loss area. This is your fixed expense. This is your sales graph. Okay, in this particular case, is 800 is sales revenue. Okay. Common financial ratio will be revenue ratio from average revenue per customer, customer retention ratio, customer lifetime revenue. The cost ratio will include gross margin ratio, customer acquisition cost ratio, CAC, monthly burn rate, and runway. Okay. And then common financial number 2, which is profitability ratio, ranging from net profit, return on asset, return on equity, liquidity ratio from current ratio, quick ratio. Okay, this is the liquidity ratio being used, and leverage ratio will be times interest earn ratio plus debt to equity ratio. Okay, so in the summary, we are doing subjective objective number 1, understanding the important financial forecasting. It is basically a process in translating your business model into dollars or cents. Okay, it makes you in a better position to know whether you should proceed in your entrepreneurial business venture or not. It can also use by external shareholders to evaluate the opportunity to partner with or lend money or invest in your business. In terms of the objective number 2, estimate your total cost. You are able to estimate your total one-time cost. You estimate your initial operation cost and ongoing cost. And you have the at one-time cost and ongoing cost to provide you with total estimate of the amount of cash that you require to do the business. Chapter 3 will be chapter 3 on the objective number 3 to develop the pro forma statement, include the pro forma income statement, pro forma cash flow, and pro forma balance sheet. And lastly, for the objective number 4, measure the financial value of the business. Using pro forma statement, you can use financial ratio to better understanding your potential health and performance of your business. And break-even point is the most important financial ratio because it indicates your business begins to make profit. So that's basically conclude the chapter 4. So it is only focused, this chapter focus on the financial side aspect. Okay, we will discuss different chapter 5 next in the next video. Thank you everyone who follow up these questions. It's also available in Edpuzzle.